Today, we're looking at a stock that recently plummeted by almost 50% in a single day and has lost nearly 75% of its value since its peak. We're talking about Fiserv here, a global fintech company, not some small outfit, but a truly well-established business that also posts solid profits. And now, from a value investor's perspective, we want to take a look. After this crash, could this be a buying opportunity today, or is the risk still too high? What does Fiserv do? Fiserv specializes in payments, banking technologies, and services for merchants and financial institutions. They provide the infrastructure, software, and services for various segments, not just for the banking sector, but also for small businesses, larger companies, other fintech firms, and more. So here we have a company that is very broadly positioned and firmly established in many areas. And once a company starts using such a payment service provider, they don't just switch everything overnight, because such changes always come with high costs and significant effort, like retraining on new systems and so on. And that's why there's a certain economic moat here, of course. But let's take it step by step and first look at the stock price. Here since 2015. Back then, the price was around $44. Now it's at $64. That's still a gain of 45%, but in the meantime, it went much higher, all the way up to $238. At that point, there was over a 400% increase in the stock price. And now, since February of this year, it has dropped nearly 75%, back down to these $65. And with that, it's at the same level as in December 2017. And investors who invested recently are clearly in the red here. The current market capitalization is about $36 billion. And if we take a look at the key figures here and just consider the PE ratio, it's currently at 10.3, which could indicate that the company is now cheap enough for a value investor. But of course, the PE ratio alone isn't enough. You have to consider a few other factors, and that's exactly what we're going to do now in this video. And if you like these kinds of analyses from me, feel free to give the video a like. It doesn't cost you anything, and it helps me to keep growing here. Let's take a look at the long-term development of the business. Here we see the figures since 2012. Back then, revenue was at $4.4 billion. Now it's at $21 billion. Net profit back then was $600 million. Now it's at $3.4 billion. Free cash flow per share has risen from $1.55 to over $12. So everything keeps going up here, and the company has also been buying back its own shares, specifically since 2019. Back then, there were 680 million shares outstanding. Now there are only 558 million, so over 100 million shares have been bought back, and the number of outstanding shares is currently even lower. We'll see that in the current quarterly report in a moment. All in all, we can see a very strong long-term business development here so far. Now let's take a look at the valuation level here as well. At the very top, we see the stock price since 2011, back then at just under $10. Then in the middle, we see the earnings per share, which have steadily increased over time. But there were also some dips. Here, after 2018, earnings per share went down. And then on top of that, there was the Corona crash. But even then, over a 12-month period, the company always posted profits, specifically $1.22 per share. And then it kept going up, until most recently reaching $6.50 per share. And if we look all the way at the bottom, here we see the development of the PE ratio. Back in 2011, it was just under 13, and now we're here at 10. So we're at the lowest level in almost 15 years. And in the meantime, it even went up to 90 at one point. But of course, that was also because profits took a hit during COVID. But even after that, the PE ratios were still at 30 here, for example, in 2022, and then even 40 at the beginning of 2025. And then the stock price dropped dramatically, as we can see up here. But the earnings per share didn't, so the PE ratio is currently only 10. And what happened? They just released the report for the third quarter, and after that, the stock dropped by about 50% again, and they significantly lowered their outlook. Now they're saying they're only going to grow by 3.5% to 4%. But you have to say they're still growing. Judging by the stock price, you might think that growth hasn't just slowed down, but has actually turned negative by now. Even the earnings per share are anything but negative. They're expected to be between $8.50 and $8.60. But up until now, people had expected significantly more. Growth rates were also expected to be higher, and the free cash flow, which is supposed to be at $4.25 billion, was also previously forecasted to be higher. For example, we can take a look at what was forecasted at the beginning of the year. Back then, they expected double-digit growth rates of 10 to 12%. Earnings per share were supposed to be over $10, and free cash flow even at $5.5 billion. And now all of that has been significantly revised downward, which of course didn't sit well with the shareholders. And many people who invested in Fiserv because it was growing so strongly over the past years have now pulled out, since the growth has clearly slowed down. And these panic sales, I would almost call them, might actually be a good entry opportunity for long-term value investors. Then let's look at the current quarterly report, and we see that there aren't just 558 million outstanding shares, but as of October 24th, there are actually only 537.8 million outstanding shares. So they're continuing to buy back their own shares very, very aggressively. I'll get to that in a moment, but first, let's start with the income statement. What does it look like here? In the past quarter, revenue stayed almost the same compared to the previous year. That means there was basically no growth, going from 5.215 billion to 5.263 billion. But net profit has increased significantly, from $564 million to $792 million, and earnings per share rose even more sharply because shares were bought back from 98 cents to $1.46. However, this increase in net profit is due to a special item, which isn't directly related to the operating business. In fact, operating profit actually declined from $1.6 to $1.4 billion. That's obviously important to keep in mind here, but just as important is not to look at just a single quarter. We can also look at the entire 9 months of the current year, and there we see that revenue increased more strongly than in the current quarter, namely from $15.2 to $15.9 billion. Operating profit also increased here from $4.2 to $4.5 billion, and net profit rose from $2.2 billion to almost $2.7 billion, or $4.83 per share. So, operationally, things are definitely not going badly for Fiserv. They continue to generate solid profits, maintain good margins, and are still experiencing slight growth. In terms of valuation, this could be interesting because, as we've seen, they expect about $4.2 billion in free cash flow for the current year. With a market capitalization of just over $35 billion, that's a price-to-free cash flow ratio of under 10. However, of course, we also need to take the financial situation into account here. For example, we can see here that they have short-term assets of $24 billion. They have short-term liabilities of $22 billion. This means these are covered, so they should remain liquid over the next 12 months. Additionally, they have a high free cash flow, which can also be used. So, for now, the financial situation is fine here. But what we also see is that they have $1 billion in cash, but at the same time, down here, $28.9 billion in financial liabilities. And that's a negative point that absolutely needs to be considered because that's a very, very large chunk of debt they have, especially with a current market capitalization of $35 billion. We have to add these financial liabilities to get the enterprise value, and that brings us to just under $65 billion. That is the current market capitalization plus the net financial debt. And if we then calculate the adjusted price to free cash flow ratio, we get a value of about 15. But that's still not expensive. There are many companies on the stock market that are currently valued much, much higher, and an adjusted price to free cash flow ratio of 15 for a company that is expected to continue growing slightly with high free cash flows and share buybacks is, in my view, not too expensive. So let's also take a look at the cash flow statement. We see that the current operating cash flow in the first 9 months is at $4.1 billion, of which $300 million are stock-based compensations. That means there are $3.8 billion left, and of that, $1.3 billion was spent on investments. So that leaves about $2.5 billion in free cash flow, roughly speaking. And what did they do with it? They clearly bought back their own shares here for $5.7 billion, which is significantly more than the free cash flow in the first 9 months. That means, where does the money come from if you spend more on share buybacks than you actually bring in? Of course, you take on more debt, and we can see that in the balance sheet, specifically in these long-term financial liabilities, which now stand at $28.9 billion. Last year, they were still at $23.7 billion. So, within 3/4 of a year, about $5 billion in new debt has been taken on here. And that's also something I like less, that they're buying back a massive amount of their own shares, but not financing it from operating business, rather by taking on more debt. Of course, that also means more interest costs that you have to pay every quarter on the debt, and at the same time, the financial situation gets worse if there are ever really tough times operationally. But there are also some more positive points. For one thing, Director Fritz bought 10,000 shares at $65 per share on October 30th, 2025, so he invested a total of $651,000 in the company Fiserv. So that's an insider purchase here, and that's always a positive sign. Of course, there were also some insider sales here, but those were a bit older back in July and May of this year. And we can also see, for example, an insider purchase of $18 million in March. However, as we can already see here in the stock price, back then the shares were bought at $112 and sold again shortly after for $184. And this is because management receives stock-based compensation, for example, in the form of options, with an exercise price significantly below the current share price. And so they can exercise these compensations they receive directly, for example, at $112. So for $18 million, you receive 159,000 shares, and you can then sell these on the stock market at current market prices. That's exactly what he did here. Actually, even a bit more. 204,000 shares at $184.95, which brings him $37.8 million in return. So he made a nice profit here. So this wasn't an insider purchase because he was convinced by the company's current price, but simply because he received shares, which anyone can get for goods or services. And that's different with this current insider purchase. Here, he really bought at the current share price of $65. And it's not just insiders who are invested in Fiserv, but also a very well-known value investor, Seth Klarman, whom I personally hold in very high regard, one of the best investors in the world, in my opinion. And in Q2, he bought Fiserv, a completely new position, and weighted it at 3.75% in his portfolio. That means for about $154 million at a price of roughly $172 per share. Now the price is at $65. So here, Seth Klarman is clearly in the red, and we have the chance to buy in much cheaper than one of the best value investors in the world. At the same time, we can also see here that even the best investors aren't always right. Even Warren Buffett isn't always right. And I always emphasize this. It's not crucial to always be right, but rather to achieve good returns on average so that you can be successful in the stock market over the long term and also weather tough periods like major crashes. If you enjoy these kinds of analysis videos from me and you're not yet subscribed to my channel, feel free to subscribe. Hit the bell as well, and then you won't miss any of my videos. Let's also take a look at what the analysts are saying. For 2025, they're expecting earnings per share of $8.66, then $8.84, and for 2027, $9.66. That means, on average, they are also expecting further growth over the next few years, even if the growth isn't 10 or 15% per year anymore. Still, it's a company with a price-to-earnings ratio of 10, or an adjusted 15 that is expected to keep growing. In my view, this is a good opportunity to get in now. I haven't invested myself yet, but if you want to know when I do invest in my community portfolio, I make a video about it every month, of course. And when I invest in my main portfolio, you can find all the details on my analysis platform. Another stock that I have already bought, and for which I recently made a video about the latest quarterly figures, is PayPal. I'll link the video for you here. Feel free to check that out next, and I'll see you next time on German Value Investor.